Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel and want to hear more about personal finance, please subscribe. In this video, I'm going to talk about universal life insurance products, how they work, and who they are and are not suitable for. Let's get started. Before I get into the details about universal life products, I'll review the life insurance product type breakdown. I've already covered in previous videos the difference between term and common permanent life insurance product types like whole life and GUL, or guaranteed universal life. In this video, I'll be talking about the remaining universal life products and how they work, along with who they are and are not suitable for. Here are some general characteristics of universal life insurance. Universal life, or UL, sometimes referred to as current assumption UL, provides both life insurance protection and a savings component which can be used to build cash value like whole life insurance, except with flexibility in premiums. With UL, cash value is made up largely based on annual premiums, initially subtracting out upfront sales and administrative costs. Administrative policy costs and insurance costs, including the cost of any riders, are deducted from the policy's cash value. Interest on the cash value is credited to policies monthly based on a rate declared by the insurance company. That rate is based on the current interest rate environment and the insurance company's earnings on the portfolio to meet future payments to policyholders. There's typically a guaranteed minimum interest rate in the range of 1 to 3%. Usually it ends up being 1 or 2%. While the policy is in force, the policy owner has access to the cash value through policy loans or withdrawals. Loans accrue interest and will reduce the death benefit and cash value available for withdrawals. Excessive loans and withdrawals may cause a policy to lapse and can cause income tax issues as a result. If any loans are outstanding on the policy at death, the loan and interest will be deducted from the death benefit. Although a premium pattern is established at the time the policy is purchased, universal life policy premiums are flexible. The policy owner can manage premium flexibility based on their needs to either emphasize death benefit protection by funding at a minimum level or maximizing cash value by increasing premiums, subject to maximums allowed by the IRS. There needs to be enough cash value in the policy to cover the insurance costs for the policy to stay in force. With the flexibility that comes with policy premiums, the policy owner assumes some interest rate risk. If interest rates drop below what was initially used when the illustration was run and the premium schedule was established, the policy cash value may not be sufficient to cover the riders and the cost of the insurance, which would cause the policy to lapse or require a substantial increase or influx of premiums to keep the policy in force. Alternatively, if interest rates increase, the policy owner may be able to lower premiums paid into the policy or build higher cash values than originally estimated in the illustration, but this is somewhat rare. There is also additional flexibility by allowing the policy owner to reduce the policy's death benefit to lower overall premium costs. Death benefit increases will typically require evidence of insurability and must meet IRS maximums. A feature of UL policies and the two other types of UL products that I'll be talking about, variable universal life and indexed universal life insurance products, have the ability to select a death benefit option. There are two typical options available, each with its own advantages and disadvantages depending on your needs. There is also a third option that is rarely used called return of premium that is almost strictly used for key person or key man insurance for business planning purposes. So here are the two common types you might see on a life insurance illustration. Level, also called type A or option 1. The death benefit generally remains constant and is equal to the policy's face amount at the time of purchase. The amount payable at death is typically equal to the face amount minus any outstanding loans. This option tends to minimize cost of insurance charges, or COI, in the long run as the death benefit stays the same, but cash value will likely increase. This is both an advantage due to it being a lower cost for death benefit protection and a disadvantage since the death benefit does not increase over time. Return of account value, also called accumulation or variable, type B or option 2. The death benefit generally changes along with the policy's cash value. The death benefit will generally equal the face amount plus the policy's cash value minus any outstanding loans. The increasing death benefit can act as an inflation hedge and also allows higher premium contributions. This could be an important factor for people looking to maximize the policy cash value. The disadvantage of this option is higher cost of insurance as the death benefit increases over time. Here is what a current assumption universal life insurance illustration looks like for a 35-year-old male, preferred non-tobacco, 15-year payment period, $1 million death benefit with a no-lapse guarantee to age 120. So who should and should not consider current assumption universal life insurance? It might be suitable for people looking for permanent life insurance protection with the ability to build cash value similar to whole life, but with flexibility in the premium structure and are willing to request in-force illustrations from the insurance company every year or every other year. Have conservative or moderate risk tolerance but are looking for more flexibility in terms of premium payment schedules and loan and withdrawal features than what whole life can offer. People that are willing to assume some interest rate risk at the trade-off for lower premiums in the near term, since declining interest rates may require higher than initially planned premiums to keep the policy in force in the future. It may not be suitable for people who only have a temporary need for life insurance, individuals with a potential short-term need for cash, such as purchasing a home, paying for college, or investing in a business, people looking for a guaranteed death benefit, certainty that their premiums will not increase, or guaranteed cash value. Universal life insurance is an alternative to whole life insurance that provides flexibility in terms of both the premiums and the duration of coverage. With the ability to have flexible premiums in universal life products comes a fair amount of complexity across all universal life products. A traditional current assumption universal life, in my opinion, is somewhat of a niche product because it really doesn't have a standout feature compared to other permanent life insurance products or even other universal life products. It's just more conservative than the rest of the universal life product options since they all have flexible premiums with the exception of guaranteed universal life, also known as GUL, which I spoke about in my previous video on common life insurance products. I'll link that as a pinned comment and at the end of the video if you haven't watched that yet. In general, index universal life and variable universal life tend to be a little bit more common than current assumption universal life. Here are some general characteristics of indexed universal life insurance. In most aspects, indexed universal life works similar to traditional universal life, except for how policy cash value is calculated and interest is credited. Here are some key features that overlap. Provides permanent life insurance protection. Cash value is part of the insurance company's general account and would be subject to claims of creditors of the insurance company, if any, not in separate subaccounts like in variable universal life. Includes a fixed account that operates the same way as a cash value account in a current assumption universal life product. Premiums are flexible. As long as there's adequate cash value to cover the monthly insurance costs and policy fees, the policy will remain in force. The policy owner assumes the risk of lower than expected interest credits. If credits are lower than initially illustrated, more premiums may be required to keep the policy in force. Could contain a long-term no-lapse guarantee death benefit as an additional cost feature. As long as premiums are paid on time and in full, the death benefit would remain in effect during a specified period, even if the policy's cash value drops to zero. Has nearly identical features and riders. Chronic illness or long-term care riders typically mirror what is offered in the insurance company's universal life or variable universal life products. These are the features that are unique to indexed universal life. Premiums are not actually invested in the selected benchmarks or indexes. They are simply used to calculate interest credits toward cash value. Indexed universal life products have a cap or ceiling on growth, a floor or minimum for downside protection, and sometimes a higher or lower participation rate. Interest credits may be based on the return of one or multiple market indices. In addition to offering multiple indices, most indexed universal life products incorporate a variety of methods to determine interest credits. The most commonly used index option is the S&P 500 index, which excludes dividends. The most common interest rate crediting method is 1 year point-to-point, capped with 100% participation in the return of the index. Under this method, the crediting interest rate is based on the full point-to-point percentage increase of the selected index up to a maximum rate established by the insurance company at the beginning of the segment year, referred to as the performance cap. This method also includes a guaranteed minimum interest rate called the performance floor, which is typically 0%. Sometimes the floor could be 1% to differentiate their index universal life product from other insurance companies. Point-to-point crediting rate is how the return is calculated based on the benchmark index selected, starting from a specific time of month and year. If the change was plus 15% with a performance cap of 8%, the interest credit would be 8% if there was a 100% participation rate. If the change was negative 15% on the point-to-point, the change would be 0% because of the performance floor. Participation rate is the percentage of positive index movement credited to the policy. So if the selected index increased 10% and the IUL had an annual participation rate of 70%, the policy would receive interest credit of 7% on the policy anniversary. Participation rates on IULs today range from 45% to 160%. There are also uncapped choices occasionally which offer no limit on the maximum crediting interest rate, but the trade-off is lower than 100% participation in the return of the index, such as 60 or 70%. Uncapped versus high participation. They trade off with each other. The uncapped has lower participation rates, and the higher participation generally has lower caps. Roughly speaking, they are fairly close in terms of performance. The uncapped option has a slightly better chance to outperform the capped option only if the returns can typically exceed 15 to 17%. Here is what an indexed universal life illustration looks like for a 35-year-old male, preferred non-tobacco, 15-year payment period, $1 million death benefit with no lapse guarantee to age 120. So who should and should not consider indexed universal life insurance? It might be suitable for people with conservative or moderate risk tolerance looking for flexibility in terms of premium payment schedules and loan and withdrawal features than whole life can offer. People who are less interested in the relatively low interest rates offered by traditional current assumption universal life, but see participation in the stock market as an opportunity to increase their cash value, but are concerned about the potential downside risk of investment choices in a variable universal life policy. People looking for death benefit protection and cash value growth that can be accessed in the future through policy loans or withdrawals. Willing to accept limits through performance caps set by the insurance company on returns against the selected benchmark index, as well as for market crash protection through the performance floor also set by the insurance company. It may not be suitable for people who have only a temporary need for life insurance, people with a short-term need for cash for things like purchasing a home, paying for college, or investing in a business. Individuals with an aggressive risk tolerance who would prefer to invest in equity markets with more investment choices may prefer variable universal life as a better option. Indexed universal life in general may perform slightly better than a comparable whole life policy, but also takes a much more complicated path to get a potentially higher cash value. My opinion is that if you're researching indexed universal life, you probably already have money invested in the stock market, and it likely isn't necessary to take additional risk within a life insurance policy for only slightly better or similar performance to a comparable whole life policy. The only difference then would be the flexibility in the premiums with an indexed universal life policy. However, even if you lower premiums on an indexed universal life for a few years, you may eventually need to pay additional premium in the future if the policy does not perform as expected. Also, people tend to rarely check on the performance of their life insurance policies every year by requesting an in-force illustration. They normally would check on their investment portfolios, even though both should be reviewed annually. Part of it is probably the ease of just being able to log into your investment account compared to requesting an in-force illustration from the insurance company, which requires either calling or at least emailing the insurance company and then some wait time to receive the illustration back. Here are some general characteristics of variable universal life insurance. Variable universal life insurance has features of universal life insurance, but with the additional opportunity to earn market returns on the policy's cash value. The rate of return on the cash value portion of a variable universal life policy varies depending on the performance of the sub-accounts or investments selected by the policy owner. Funds may be reallocated between the available investment options without incurring income taxes. Note that individual products may impose certain restrictions on the frequency of reallocations. The performance of the separate account is not guaranteed by the life insurance company. In addition to the variable sub-account choices, VUL also has a fixed account with a minimum interest rate. Some VUL products may even offer multiple fixed account options to choose from. If there are multiple fixed account options, one of them will have a higher crediting interest rate, but has more restrictions in terms of transferring funds in and out. In the last few years, insurance companies have been adding indexed accounts to their list of investment choices, similar to what can be found in indexed universal life. These accounts are not the same as an indexed sub-account where funds are actually invested in a portfolio of securities that make up the index. Indexed accounts are not a direct investment in the index. Indexed accounts determine a crediting interest rate through different methods, and the index is used like a benchmark instead. The most common method is 1 year point to point, but some products may use longer periods. Then, based on the performance of the selected index, usually the S&P 500, during the measurement period, an interest rate is established and credited to the account. Indexed options will also typically have a guaranteed minimum rate to provide downside protection in the event of market declines or crashes, which is typically called a performance floor. Index performance caps and/or participation rates are declared by the insurance company. If you need a refresher on how this works, skip to where I discuss in depth on the 1 year point-to-point interest crediting method within indexed universal life in this video. Most companies provide policyholders with the ability to select a number of sub-accounts from several fund families and different investment classes. These professionally managed investment options, which are the sub-accounts, allow the policy owner to have access to a variety of investment management styles and different levels of risk. Variable universal life products also offer an investment choice that provides a guaranteed interest rate known as the fixed account. Here is what a variable universal life illustration looks like for a 35-year-old male, preferred non-tobacco, 15-year payment period, $1 million death benefit with no lapse guarantee to age 90. So who should and should not consider variable universal life insurance? It's suitable for people with moderate to aggressive risk tolerance looking for permanent life insurance protection with an opportunity to grow the policy's cash value. People should also have the ability to increase future premiums if the policy does not perform as anticipated since the time of issue and would otherwise be in danger of lapsing. Some VUL policies offer a long-term no-lapse guarantee feature, making them a great option when looking for no-lapse guaranteed death benefit protection, though it varies by state. Someone who has fully funded other retirement plan options first, like IRAs or 401ks, and still has additional cash beyond those contributions could consider a variable universal life to supplement their retirement income. It's not suitable for people who only have a temporary need for life insurance, people with a potential short-term need for cash to buy a home, pay for college tuition, or invest in a business. People looking for a guarantee that their premiums will not increase. People looking for either guaranteed cash value or a guaranteed death benefit. Variable universal life has the potential to perform better than a comparable whole life policy, but by taking risk through the stock market and selected investment choices to get to a potentially higher cash value. My opinion is that if you're researching variable universal life, you probably already have plenty of money invested in the stock market and are looking for additional supplemental income in retirement and have already maxed out the contributions in other retirement accounts. So there are two approaches if someone has a high income and additional money to put into a variable universal life policy. They could take a more conservative route and go with a whole life with no market risk and more predictable performance, or go with the variable universal life and take market risk within the VUL policy for potentially even higher cash value performance. Neither choice is wrong in that situation, but it's strictly up to whoever is buying a life insurance policy and what their financial goals might be. Here is a chart comparing the key features of all the life insurance product types. I already talked extensively about guaranteed universal life insurance in my previous video on common life insurance products, which I'll link at the end of the video and as a pinned comment for you to check out, along with my video on what you need to know before you buy life insurance. Think about what types of policies might work for you or your family, and keep in mind that buying a combination of coverage based on your financial needs is a possibility, and they don't have to be any of the universal life insurance products I talked about in this video if that's not what works for you or your family. All life insurance products work for someone and were likely designed for a certain type of individual. But that doesn't mean each type works for you specifically. Consider all life insurance products before making a decision and consult your financial advisor or insurance agent for guidance. After watching this video, I hope you're more informed before potentially buying any life insurance policy. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.